YouTube started out as video dating. It was called YouTube and Hookup. And they pivoted into broadcast themselves. I don't know. Did you know that?
I didn't know that, no.
So now you know that. Flickr, the image sharing platform, was a role-playing strategy game. But all people wanted to do was share the photos.
Wow.
Twitter was called Audio, and they were podcasting. And then Apple entered the market and they adjusted to microblogging. The point being is that a lot of companies, when they start, their hypothesis is not what actually ends up gaining traction in the marketplace.
Welcome to our podcast, The Ground Up, where we interview startup founders exploring their journeys, their success, challenges, and lessons learned. We hope you be inspired in discovering what it takes to build a thriving startup. Zack Dugow is the CEO of Insticator, Balihoo and Oko, where he bridges revenue opportunities to online communities and ad technology, leading a global team overseeing 2,000 publishers and over 1,000 advertisers and 500 million users. He's earned accolades including a top 40 under 40 CEO from Crain's New York and won awards for Insticator from the Inc. 5000 to Deloitte Fast 500. He's an active member of YPO, Forbes Tech Council, investor, and mentor to other entrepreneurs. Zack, welcome to the show.
Great to be here, Jake.
Well, before we dive in here, you and I have both lived in New York, which I love, by the way. Now you're in Miami. What led you to Miami?
So I still spend some time in New York, but I am primarily in Miami. I think there was probably 3 or 4 things. The first being during COVID, we had our whole team go remote, and it really worked very well for the rest of our team and myself. And we started expanding where we looked for talent, as opposed to just being like, hey, is somebody in or near one of our 4 or 5 offices? Can they be anywhere? And I have family in Miami, but more than that, there's also like a thriving business ecosystem. There's a lot of new exciting like YPO chapters and tech companies, and then frankly, a part of it was also just like, where would I rather wake up in December if I'm going to be working from home? Would I rather be in 10-degree weather in the freezing cold snow, or would I rather be looking at the ocean? And look, you're speaking to somebody who was born and raised in Manhattan, New York. And so I still love New York City, but I've really come to appreciate everything that Miami and Southern Florida has to offer. And I think it's been a nice adjustment and change of pace. Plus, also, people talk about it plenty, but the tax benefit of not being a New York resident is also a very big plus.
No doubt about that. We've heard a lot about that. That's great. Many entrepreneurs we've talked to on this show and just in general have started companies well before they got out of school, some in high school, some earlier. When did you start your first company?
I was in college. So I was going into senior in college. And so I guess 21 in that range.
And in college, you're going to school, you're developing as a person, you're kind of coming into your own socially. What was it that drove you to create a company during college, and what specifically did you create?
Yep. So I was always curious about business and how businesses made money and in different ways. And so, the first company that I started, we did internet ticketing for food and liquor brands that had like a whole promotional marketing element to it. So think of it like we had a ticketing platform that was like half tech, half services that would sponsor events, have liquor, food and beverage companies sponsor the ticketing platform, and then have like fees associated to it and a whole promotional team that would support it. And that really just came from like grassroots being in New York City and seeing an opportunity, and one thing led to another. There wasn't like this aha moment. There wasn't like, oh, this is my broad vision for this. It sort of just got created out of necessity. Just expanded. And so I had that company before selling it at the end of 2011, beginning of 2012. So before starting Insticator, which we launched in July of 2012.
Amazing. Let's get into Insticator. I know that for those out there, you're in a space that you know really well, online content, and I'll let you kind of get into your platform specifically, but walk us through what was the idea behind Insticator when you started it and where it's at today and what problem it solves.
Yeah, completely different. And the way I like to talk about it is most people, Jake, don't realize or think about that a lot of successful tech companies start out as one thing, pivot entirely into what will drive value. So like YouTube started out as video dating. It was called YouTube and Hookup. And they pivoted into broadcast themselves. I don't know. Did you know that?
I didn't know that. No.
See, now you know that. Flickr, the image sharing platform, was a role-playing strategy game. But all people wanted to do was share the photos.
Wow.
Twitter was called Audio, and they were podcasting, and then Apple entered the market and they adjusted to microblogging. The point being is that a lot of companies, when they start, their hypothesis is not what actually ends up gaining traction in the marketplace. And the teams and the companies that succeed, in a lot of the time, in my view, are the teams that adjust fast enough to the market and building something that will drive value. And oftentimes it's very different from what they set out to. Not in all cases, right? Like Instagram set out to be a photo editing ad, and but there's in a lot of cases. And so what Insticator first was a B2C web application where people could predict outcomes of TV shows and sporting events that they could win points to redeem for rewards. So think of it like you'd go to the site, you'd predict what happens in the Vampire Diaries online or Game of Thrones. And if you were right, you'd get a bunch of points. And you could take those points and be like, all right, I'm going to redeem this for a Game of Thrones jersey, or I'm going to redeem this for a Vampire Diaries pendant. And the idea was to be ad supported and really incentivize these exciting behaviors. So that's what Instigator originally was. We launched with that, had success with that, got to like 50,000 or so users. But in order to really get scale, we realized we had to kind of pivot the technology to be an embedded experience and say, okay, instead of trying to get all of the excited fan communities into one place, let's go to where the fan communities are. And we tweaked our technology to be what is currently Instigator's content engagement unit, where users engage with trivia, polling, content recirculation, and then we use all of this data to feed this back to the publisher for a better experience or to the advertiser so they can monetize that user more effectively.
So who pays for your service?
So, that's just one of our products. So that product, as an example, is ad supported. So essentially we put it on a publishing site and then we have a revenue share with them. So we then have advertisers that'll buy advertising connected to the experience. And we'll say, okay, great, we're going to pay you 70% or 50% or whatever that specific deal is, or of that specific ad space, typically a 50-50, and then we'll pay them out a percentage of the ad revenue that's generated. So connected to our technology is ad units that advertisers buy space on. We collect that revenue and pay out a percentage of that to the publishers we work with for our content engagement units.
I love that. And, the world's gone to digital and it seems to continue to evolve. As a company today, and you started, is it 10 plus years now back? More than that?
Yeah, 11 years ago.
Yeah. Where are you as a company, as an employee size, and really just as an organization?
So we're around 90 or so people, full-time and contractors and stuff included. And we've acquired companies. So we do a lot of different things. So one of the products we have is what we initially pivoted into, which was content engagement units. And the other part of our Insticator business is our commenting product, which we acquired and grew, where users can log in and comment. You've seen it probably on thousands of sites. You just didn't realize it was our product unless you looked for the Powered by Insticator. And we use all of this data and use natural language processing to scan comments and bucket people into audiences. And about 3 years ago, we acquired a company called OKO Digital, where we are now one of the leaders in CTV monetization. So connected TV, like smart TVs like Roku and a whole host of other smart TVs, we drive monetization by bringing in advertisers where you'll see ads through these connected TVs or broadcast video on demand, as well as managing all of the ad units for publishers or for an in-app publisher. And so that's become a very big part of our business and what we do vis-a-vis acquisition. And then we also have two other parts to our business. One is a company called Balihoo, where for brands, we localize all of the ad creatives through search, social display, video, and the landing pages. So a company like Kohler, who's a customer of ours, we'll make sure that you get an ad unit, Jake, for the Kohler store you're closest to within a 5-mile radius with an ad campaign and ad creative that's custom to you in that store, so that we drive a higher return on ad spend, typically like 5-to-1, which is really good for the industry. And then just last week, and I could talk about it now, we acquired another company on Wednesday of last week. It's exciting, based out of Australia, where we have a very cool CTV reporting dashboard that we're offering to customers, and we do managed service media spend. So as you can hear, there's a lot of evolution from what we started out doing, which was predictions on TV shows, into really kind of the 4 different core elements of our business today.
There's a lot of companies that build organically, and as they grow and they scale, they're always trying to figure out, like you talked about, adapting and figuring out how to do it quickly so they can survive or maintain or scale. But earlier stage companies don't often go into acquisition mode. I mean, you look at bigger companies like Amazon or Oracle or Microsoft, maybe not so much Microsoft, but other companies, well, actually Microsoft too. Their growth by acquisition is very much a strategy. You started doing this as well, but before doing it, did you have experience of how to assess a company, how to acquire it? Is it a bet you place and hope for the best? And then post-acquisition, what have you learned that's been really helpful in making sure that the integration goes well and what you think is going to happen happens?
Yeah, that's a really good question. So to speak to your first question, did we have experience in doing it? No. So we learned a lot through each acquisition, and each one got progressively better and better through the process, because our team became so much more effective. There's still a lot of things to learn. I would say there's 4 key things we look for now when we're looking at a business. And the first is actually very different than what most people think. Before really thinking about and evaluating, like, here's the revenue and here's that market opportunity and so on, it's great to actually understand the culture of that business. And when I say that, I mean, like, how are decisions made? What is the work culture at that company? Do people respond to emails after 5 o'clock? In the US, that may be very common. That may not be common at all if you're based in somewhere, some different country in Europe, or so on and so forth. Understanding, like, what is the culture of the business, their values, is really great, and understanding what is the difference between your values and their values. And there's going to be differences. You just want to go into those open-eyed so you can understand more about, like, how, like, call it like the nucleus of that business thinks in terms of, are they customer first? Cool. Are they team member first? So if they're customer first, does that mean they expect team members to jump on an issue if it's 1 o'clock in the morning? Or if they're like, so there's a whole host of bunch of different ways to run a business. But one of them that we spend a lot of time on and talk about internally is the culture of the organization, as well as, the competitive market and landscape, the team. When we acquire a company, we never look to get rid of team members. Like, we're not call it, the way that private equity will look at a company where they want to buy a company and go, okay, we've got 30% of synergy. We're going to fire all these people and we're going to get an extra 5 million in EBITDA. If we think we need to go in to let go of a whole bunch of the team, we're not going to be doing that acquisition. For us, we look to find where there's been success and traction, and that we can expand off of a really good base. And maybe there's a great team and product that has even more potential with more resources and synergies. And then we look at what else. How can 2 + 2 = 10? Like, how can what they do and what other parts of our business do come together and add a lot more value in the aggregate? Do they have team members with expertise that we don't have that can help in multiple business functions? And so to answer your first part, we've made a ton of mistakes along the way, but learned a lot that I think have made us to be, we're a lot more effective at acquisitions now than we were.
How much, when you talk about the culture, is something that you make sure that your own culture also adapts to the other company? Is there any combination where you guys say, we need to be a little bit more flexible how we operate? And maybe tell us a little bit about the culture of Insticator when you started it from the beginning, where it's at today, what are the things that are important to you as a company? If others are maybe hearing about you and saying, you know what, that's a company I want to work for, what are they getting into?
Yeah. So to your first part, I think the answer is yes, and you need to. You need to see where the difference is and where do you flex. I think a fast way to lose a lot of or all of the team members of a company you just acquired is to be like, here's the way that we do things. We don't change any of those things. You do it our way,
Not
and
going to
you're
work.
very rigid. I don't think that that's like a recipe for success. So it doesn't mean you give up your core values, but it means you want to understand how you're different and where the commonalities are and see if there's opportunities to flex. And that is like I think a much higher, stronger recipe for success. And that's really important, not just in that front, but with team members as well. Like when you're thinking about promotions and responsibilities, you want to make sure it's like a meritocracy. It's not like, oh, these people were part of Instigator, those people were part of OKO, those people were part of Balihoo, so we promote these people first. You want to make sure there's like people can see that that's very visually clear that it's the best person for the role and it's across multiple orgs. Sorry, can you just repeat the second part of your question?
Yeah, just in terms of the culture, what's your
Yes.
the core principles of your culture?
So we have three core values. The first is sleeves up. And that for us, we broke out core behaviors that exemplify the core values. And that means we really look for people who want to get their hands dirty and they don't like to lead from afar. So there's nothing wrong with it, but you used Microsoft as an example, right? There may be people who are used to being managers of managers and they kind of give a little bit of high level direction and the rest of the team kind of executes. And maybe that works really well for those businesses. For us, we really like when the people who are managing teams know how to do the actual thing for that team. If you're a design leader, you know how to actually write, make the designs in Illustrator or Figma. If you're an engineering leader, you know how to write the code, you know how to comment it, you know how to check it. We just think that for our culture, that works a lot more effectively, that you can lead by doing, and doesn't mean you're always doing all of the work, but it means you understand it at least. That you don't have a sales leader who's never actually sold, and there were some strategic MBA who came in and read books about it but doesn't know how to get their hands dirty. Our two other core values are be defiantly great, and be defiantly great. We look for people who are curious and want to learn and want to grow. And there's a lot of people who are like, look, I go into work, I do my thing, and then I leave, and there's nothing wrong with that, but that's probably not for us. Like for our culture and vibe, the people who are the most curious have the biggest impact and the most positive impact. And lastly, what we call 100% viewability. It's a play on the ad word, but what we really look for is for us to be transparent and direct, even in or especially during direct and hard conversations, that can lead to. And a lot of times that makes people very uncomfortable. And I think, though, ultimately it's a better way for running a business. And it's much more effective at aligning people to be direct, even if that's surprising. And what you'd asked about before with cultures, actually kind of Netflix did a great job breaking this out, where they broke out geo cultures around power distance. Like if you are in the most direct culture is people who are Dutch, like even much more direct than Americans. And then you've got kind of the US, and then all the way to the right, you have cultures that are super hierarchical. Like if you are more junior, you do not speak up. Meaning if you're in Japan and you're doing business, and let's say you have something that counteracts somebody who's your manager, you don't speak up, even if that might cost the company a lot of money or problems or resources. Or in India as well, you would never have a very senior person sitting at the lunch table with what's called a fresher, somebody who's brand new. And so you want to be mindful of those differences so that you can at least address them and be aware of those geocultural differences, to then be more effective at being direct, if you will. And still, that'll be surprising for people, but I think it's very helpful long-term, at least for our business. So we have team members around the globe. And so leaning into that direct part can be quite challenging and surprising and nuanced for people when it's new for them, because maybe in their career, they haven't had an experience where it's okay for junior people to be direct with senior people and say, hey, I think we got that wrong. Let's fix this. Because at their prior company, somebody would get fired for doing that. So I think being for us, that directness helps move the needle in a positive way.
That's great. I want to go back a little bit to the people on your team. You talked about you have 90 people, you're distributed, highly distributed, multiple countries. During COVID, a lot of companies had to pivot in terms of where their workers were located, whether it's in San Francisco, New York, the Midwest, and then it went to Canada, and then South America, and then Asia. And, cost of labor makes things different and easier in some capacity when you're scaling a company. Also making sure that you get the culture aspect right with who you bring on and really how to manage that. What's worked for you in terms of finding people internationally in different countries and then also managing them effectively?
So there's two parts, and it's interesting. We've had internal discussions about this. The first is we really try to centralize that most working hours overlap with EST time so that people can have overlap with their team members, with their colleagues, except in one case where like the customers are based in a totally different time zone or like certain exceptions that make sense. But so that you need that overlap. And I think it's important to set that expectation going in. So, hey, our expectation is that you're going to be available from these hours, roughly EST. And I think what's been fortunate for a lot of American companies is a lot of actually international cultures have adjusted to that. Like you have offices in India that are open to, 3 a.m. their time because they're used to providing support for the US. So we have some team members in the Philippines. You have, I think it's something like 20 to 30% of Manila, the capital of the Philippines, works on EST time. They have bars that start their happy hour at 8 a.m. because that's when people finish their work shift. Okay. And I didn't believe it. And then I saw it and I was like, oh my God, because I went to Manila and I had some more team there years ago. And so I think aligning that is really important. So even though people are broken out across the world, there can still be that central connection in terms of overlap and seeing each other and Zoom meetings. I think that's one part that's really important. And then in terms of, you had asked that, and then maybe we can edit out the parts where I'm clarifying your question.
Yeah, no problems. We'll get
What was
you
the
teed
second
up.
part?
Yeah, in terms of what tools or what's worked for you to make sure that you're managing your people effectively remotely.
Yeah. So we use a few different tools. Slack is a big thing for us. So we have Slack with customers, internal, like so many different Slack channels. Like the vast majority of our org operates on Slack. We use Zoom, even though I think we're moving to Google Hangouts in March because their whole data storing policies changed. We use ClickUp for project management, where it kind of keeps track of. We use Confluence for documentation, so people can still do their work even when there isn't overlap. And there's a lot of, and then a bunch of our different teams have specific kind of sub-specific tools. Like our engineering team works on GitHub, and there's a whole host of kind of sub-specific tools that have sort of worked well for us in that. The other thing that we look for also, and have gotten a lot better with this, but when you're hiring internationally, to really make sure that people speak fluent English and they speak it well, if that's the language of your business, that's really important. What we found is, and it's not because if somebody is less confident in their English abilities, they're actually much more nervous to share what they think, and they have far less impact on the business as a result. So somebody who's less confident in their ability to speak English, if you're hiring internationally. So we really actually look to vet that very early on, that people speak very good English, they can communicate what they're thinking, feeling without being shy, and the more communication there, the better.
What country have you found the most success in hiring really good English speakers?
Well, I mean, Canada's obvious, but that doesn't count probably towards your question because, English is native to Canada. And we also have a team in the UK. So they speak English before the US does. But I think India, the Philippines, and the Ukraine have actually worked out, I think, very well for us in terms of that. But even within that, you just, I think, need to set a very high bar early on the proficiency of English. And they have grading levels for this. You could look at the grading levels and say, hey, this is the grading level. I think it's important to set a high standard early on for that. So those three countries, I think, have worked really well for us in making sure that level of English and confidence in that is essential, both verbal and written.
Yeah, that's great. As an entrepreneur, you encounter a lot of things that you have to learn on the fly, a lot of areas that might be fearful to dive into that you don't know what the outcomes are going to be. ultimately you need courage to make big decisions often. And I always look at it as in life, you have to step up at some point to get the things that are really valuable to you. It might be asking that girl out that there's a little bit of fear, but you know what? When you look back in your life, the things that you really valued, you had to step up and make it happen, whether you got it or not. Um, Aside from that, in business, acquiring a company, you got to step up and ask the questions, put the price out you're willing to pay, whatever the issues are, whatever the fears could be. What's one experience that you look at your current company that you had some fears around, you had to make a big decision, you had to use a lot of courage, and you did it, and it paid off?
So I'll take one even from this year. So when we were buying Balihoo, we were in a bidding process, and we had set a maximum bid internally for what that was going to be, and we were bidding against another company to buy them. And it got to the part in the bidding where it hit our number, meaning we had said, okay, we're not going to go above this number. Now, I had room with our board to go higher than that, but internally in our discussions. And I was like, man, I was thinking really quickly in the head. I was like, man, I'm going to let this go away. And it was so funny. So it came back. And so then I decided, after looking at, I had an extra 30 seconds. And that 30 seconds, I was like, fuck it, we're going for it. And so we bid an extra $50,000 more, right? And they could have bid 100 more, 200 more, whatever it would have been, right? And it might have just superseded us or whatever. But I went 50,000 more than our initial kind of internal limit, if you will. And we won. And it was shocking to me. It was that little difference. Now, of course, we had no idea what was their max price to pay, and they had no idea what our max was. But if we had stopped, we would have lost. And that 50 grand difference, that extra little push the envelope, not that I'm saying $50,000 is not a lot of money, but you get it in this scheme of acquiring a company that's going to be, a huge asset for your business. And so I look back on that. I remember that. I was like, wow, because I just as easily could have been like, you know what? We had our number. We didn't hit the thing, or we weren't going to exceed this. And I'm really happy that we did. We took that courageous step there. And it is for all the diligence you do in the world, you never really know all the things until you've met the team, you've acquired them, you've integrated them, you've spent time with them. And you can't know those things when you're bidding, or just from some diligence over 30 to 60 days. So you do your best to learn as much as you can. That was, I remember that was an important moment, even in these last 12 months.
It's important. It also is important because it's not just you making a decision. It's also, the team behind you and your investors wanted to know what's going to happen. And that's great. It's little moments that make up, our lives that you look back on. And it sounds like that was one of them. That's great.
Yeah.
Really cool. As a company now, as you continue to build and grow, it's important to make the right decisions. But I think maybe one of the most important decisions is making sure the people on your team are the right fit, but more importantly, the founders and the co-founders. And I usually ask this in the beginning, but how did you find your co-founders, if you did? And do you have co-founders?
So we do not have co-founders, but we have, we have a team, and some of our team's been together a long time. Our CTO has been with me for 10 years. So, in a lot of ways, he's like a co-founder in a lot of ways. But before him, even, we had an engineer who we had hired to be our first engineer, or I had hired to be our first engineer. We were 3 people in the Juan Valdez Cafe on 57th and 2nd Ave in Manhattan. So I was like, it's we were sitting there before we went to an office that we were paying $1,200 a month for our first office on 20th and Broadway. Nice. Very cool. If you ever been to that area, the design within reach, we were on the 7th floor, and you had to walk up 6 flights. Because it was a manually operated elevator. So if the elevator wasn't working, or it was after 5 o'clock, you had to walk up or down 6 or 7 flights. But we needed to save money, so that was our first office. But so our first engineer joined us, and I think he was with us about 6 months or 7 months. And this goes back a ways, but naturally we didn't have a lot of money for salaries or pay, if anything. And of course, I didn't take a salary, I think, for the first 4 years of the business, and so on and so forth, because I was just investing money in to keep us afloat. And I think it was like 6 or 7 or 8 months in, and he had been married, and he was going to have a baby, and he was like, "Look, my wife wants me to get a real, quote unquote, like a paying, like a real paying." He was getting paid, but he was getting paid like a tiny amount of money. And so, ultimately, it obviously, it didn't work out to keep him on board because, he needed to. And I totally respect that. And I get it. Like a lot of things in life is timing. And, that wasn't going to be the right time for him. So, yeah, but so, but to your question, I no formal co-founders in that sense, but, a lot of our early team has been super helpful to help us get to where we are. But, I've certainly had to wear a lot of burden myself as a solo founder from the early days.
Yeah, that's great. You're in a rare space where a lot of companies are, have co-founders and they scale, or maybe they've had companies before with co-founders and found out they really don't like that process where you want to be the one making, the decisions, or be in a process where you don't have to hear pushback. If you want to go a certain direction, you got the freedom to do that, which I think, by the way, is great. And I've had both. I had co-founders that we scaled up and got acquired. It was great. And then went solo, and I felt there was benefits to both sides of it.
So which one do you favor? Or does it depend on the business, or how do you think about it?
Yeah, I personally like the solo founder, but with a strong leadership team that feels like, a founding team, really. And for a lot of aspects, it really is, with equity and whatnot.
Yeah, exactly.
That's kind of how I feel about it. Where does your company go from here? You've acquired 3 or 4 companies. You're kind of scaling up. We're heading into 2020 already. The markets are a little bit wonky, but seem like they're kind of getting more clarity. What's on the agenda for you post acquisition and as you get into the new year?
So we're seeing a lot of organic growth. So we've been really fortunate in that we are firing on all cylinders and hiring great engineers and ad ops people and account managers and salespeople. For us, we're also on a buying, we're looking at other companies we can acquire. So we have very specific targets we want to get to over the next 2 to 3 years, and then evaluate, but I think there's a lot of exciting products and technology that we want to bring to our customers that we could gain benefit from in acquiring. So over the next year to 2 years, we'd look to, acquire maybe an extra 2 to 4 different companies, depending on certain sets of circumstances. We're talking to some right now. So, our game plan is really to grow a lot organically and through acquisition over the next 24 months. And so, something I think to keep in mind is like when there's always a good time for growth. So what I mean by like, there's always a good time for growth, I mean like, you have times like in 2021 when like valuations are super high and money is super cheap relative to like interest rates, and you can raise capital very easily and you could use that capital to grow your business. When times are very difficult like they are now, meaning interest rates are super high and the economy is super shaky, that lever of inorganic growth and the ability to buy other companies at a price that's maybe much more reasonable or feasible than it would have been in 2021. And so I highly encourage other CEOs and entrepreneurs to look at where are the inorganic growth levers in your business, that you can tap, because there could be opportunities while the markets aren't strong, but there could be great products out there and teams that are available. And if we hadn't looked for those opportunities and levers, we would be in a much different position than we are today than we were 4 years ago, as an example, when we started acquiring.
And when you go into acquisition mode, do you bring in a firm to help in the process of diligence and assessing, the operation, the financials, or do you kind of learn as you go, do it on your own, and then have like a legal team come in? What's been your recipe for success?
So we do all of this internally. And I don't think there's a right or wrong to that. I think you can be successful with, paying a big firm like a McKinsey to come in, and they'll probably point out things that maybe you don't know, or so on and so forth. I think for us and our industry and the different industries we play in are very nuanced in that like our team are really experts at what we do, I think it would be very difficult to find like a consultant who would know more than our internal teams and would be able to be like, oh, look at this area of net dollar retention or this or that. That would like really change the way we think about it. All of that being said, I think we're open to trying that at some point. But I think that's worked for us because a part of it is also like an education. So we've evaluated companies and chosen not to move forward with the acquisition because of what we discovered in the diligence or in the evaluation process. But your team learns a lot through that process. Like you get to understand how the new team members think, how they feel, how the business has trended, how they've marketed themselves. Like the diligence process is actually like a very good education process for your internal teams on what's happening in the marketplace and the landscape, plus, these new team members are going to be working with. So it's actually, in a lot of ways, really great. Like I would not favor, like if we could bring in some external consultants to just do all the diligence, they're like, great, now we've acquired them. I think it would be very difficult for us because it'd be like, wait, how are all the customers situated? How have they broken out this? How have they broken out that? At least for us, I'm sure it's different if you're acquiring, Microsoft acquiring LinkedIn and you're acquiring, 2,000 people and it's a public company. There's a lot of other variables at play than for us at this stage. But, so far doing this internally has worked very well. But we're also bolstering our internal capabilities on that. So adding internal team members that have, experience on those fronts and different kind of capabilities on vis-a-vis M&A.
That's great. Well, Zack, you're on an amazing journey. I love the growth. I love the process of how you've grown. If people or companies wanted to find you or find your company, how would they find Insticator?
Insticator.com, or find me on LinkedIn, Zack Dugow, or shoot me an email, zach.dugow@insticator.com. And, always happy to help if I can. So if I can be helpful in any way, happy to help. We are where we are today in part because we've had a lot of very helpful people who've been wonderful to us. And so happy to be helpful and pay it forward in any way I can.
Well, thanks, Zack, for jumping on here today. A huge shout out to you for taking the time, and to all of our listeners for listening. It means the world to me that you chose to spend your time with us today. On Halloween, by the way. This is Jake Aaron Villarreal signing off for now, but can't wait to connect with you all in the next episode. Until then, take care. Before we wrap up, I want to give a big shout out to all the entrepreneurs that have joined to make this podcast possible, and for all the listeners for listening. It means the world to me that you chose to spend your time with us today. I'm your host, Jake Aaron Villarreal, signing off for now, but can't wait to connect with you all soon on the next episode. Take care. This show is sponsored by Match Relevant, a company that helps venture-backed startups find the best people in the market, and they do it in 3 simple steps. First, they sit down with founders to understand their story. Second, they tell their story into multiple candidate channels. And third, they schedule interviews within 48 hours. Find us at matchrelevant.com to learn more about how we do it.